Hello, everyone. This is Gavin McGuire, also known as Event Trader. Just tuning into the Briefing Trader audio. I am joined by Brett Manning, who you guys all know as Chart Trader, and Andrew Bagu, who's one of our analysts over here, who's done a fantastic job for us on the audio product, is a pretty savvy earnings and equity analyst for us, and he is looking to delve into the futures trading aspect of things. Now, I know a lot of people on feedback when we put out, Brett or myself, futures trades, a lot of people are looking to get involved with it and just are a little bit more concerned about the aspects of futures and don't have a clear understanding. So what we are planning on doing is running this Andrew Futures Trader class, basically, to kind of teach people how Brett and I look at the futures market and some of the different aspects and nuances. We certainly want to touch upon risk and reward that's going to go out on each of the trades and help you understand leverage and exactly what you are buying. So we're looking at doing a couple part class here. This one is the introductory one, and we figured that having Andrew along as the student, if you will, in this section will help fill you guys in, and he will be your proxy. We'll certainly be available to answer questions and all that on the site, but Andrew's going to be really providing a lot of looks in and questions for us to be able to provide answers to and move forward with. So with that, I just wanted to introduce Andrew, and Andrew, take a second for yourself to introduce yourself and talk a little bit about your futures experience at the moment.
Okay, well, yeah, thanks for introducing me, Gab. I'm Andrew Bagu. I'm an analyst here at Briefing.com, and I'm a self-taught investor. Basically, when I was in college, I studied political science, got really into investing about 8-9 years ago when I read a book called One Up on Wall Street. And basically how I approach investing from a long-term perspective is I like to look at fundamental stories from a business perspective, for more longer-term type of holdings. What I'm really, really excited, though, about for this segment especially, just kind of going over how futures work in general, because I know that I've watched a lot of different trades or just information from chart and event walking through different trades and whatnot, and I really have no idea what any of it means as far as how futures. I barely even know how futures work, especially because when I first got started learning and teaching myself about investing, I really went through a lot of self-education, and when a lot of what the value-oriented books tell you is never screw around with options, never screw around with futures. But since I think life should never cease to be an educational experience, I really, really wanted to get both chart and event on and kind of just walk through futures, what it means, what the differences between different contracts, the differences between different risks, some things someone like me who doesn't have any experience trading futures, some things to be wary for or look out for. So I'm really, really excited to kind of get a lot of their feedback based on their own practical experiences trading, and just kind of walk me through just how futures and how this stuff works in general. Because at least when I'm taking over for some audio stuff for Jim Z in the afternoon, and I might go over some of the trades, I might read them out loud, but it doesn't really mean much to me. So I'm really, really excited to kind of have chart and event walk me through this process.
All right, and I guess I can pick up the baton from there. Thanks, Andrew. Thanks, Gavin. My name is Brett Manning. You see me on the site as Chart Trader, and I have been trading futures actively for about 20 years, and I have a lot of experience in futures instruments, from equity markets to bond markets, commodity markets, currency markets, pretty much everything. And I have been through good times and bad times, and I have had a lot of practical experience to try to offer to Andrew so that he can do this. And the one point that I wanted to start off with is, so if you do a search for futures markets or beginning educational materials, you may come across some stories that are essentially reasonably popular on the internet of, hey, I just blew up all of my account trading futures. I switched to futures, and that's why I blew up my whole account. And so I wanted to start right off with an analogy, and we can work from there. And the analogy is this. Let's say you had to clear a property of trees and brush and bushes, and you want to build a house there. And you look in your workshop, and you've got a handsaw and you've got a chainsaw. And you can use either one. And so you go online and you search, hey, what's this deal with chainsaws? You'll find a bunch of stories of people ending up in the ER with, an inch wide, 3-inch deep gash down to the bone in their thigh, and the loss of use of their right foot. That's the story about chainsaws. That's what can happen to you. However, under certain circumstances, it's still the practical tool to use. And as long as you go through a checklist of safety measures, you can basically eliminate that risk. As long as you always, wear thick gloves and wear safety goggles that cover your entire eyes, and after you start up the motor, you put the chain safety on until you get right in front of what you want to cut, and you get a low center of gravity and your knees bent and balanced, and then you pull the safety back off and you cut through what you want to cut. If you do that every time, you will never, ever, ever have an accident with a chainsaw. And futures trading is kind of a similar issue. You want to take the proper precautions. You want to have the proper limitations in place so that the way that you approach it on a very basic level prevents a blow up. So to drive this point home a little bit more, I want to take a moment to describe what a futures blow up looks like, and then we'll kind of move from there. Once we understand how to prevent that, we can then understand what to do and how to use futures, but we first need to understand how to not use futures. And a lot of people, I think, have a mistaken idea about what a futures blow-up looks like. People who don't have experience with futures. It's like, I was trading futures and then something crazy in the market happened, and because I was trading futures, I blew up my account. And there's that murky part in the middle. And the real risk with futures isn't because of some mechanical strange thing that happens just because it's futures. It's because you have the tools to blow yourself up, and you put yourself in an emotional situation because you were wrong about something, and you're trying to get that money back. And the deeper in the hole you get, the fact that it's futures and they're so leveraged that even with your account cut in half, you can still triple your size. And if it just moves a little bit back in your favor, boom, you make it all back instantly. And the ability to do that is what causes people to blow themselves up with futures. So that is kind of the critical first point. And that leads me into the two things that we're going to work on then right from the beginning with Andrew so that he never does that. There are two things that if you do them, you will never be in that situation. The way that sort of blow up happens is because you start off with a setup that you believe in, and you take a little bit more size than you should, and you take a little bit wider risk than you should, and you take an initial hit. And that initial hit puts you in an emotionally vulnerable situation, and the leverage is available for you to scale up. But there's another thing that was wrong with the situation. There's another thing right off the bat that caused it, and it's that the setup that you took, the thing you were interested in trading, was not a falsifiable setup. So I want to go over what that means really quickly. So we start with the idea that futures trading means interacting with markets on only falsifiable setups. Setups where, just based on the structure of the setup, it's wrong if it goes against you. And that's how you see it, right? So the two types of setups, for instance, that aren't falsifiable, Andrew just mentioned one a moment ago. He said value positions. If you have a value thesis in a market, don't use futures. If you think the market is overvalued, don't short the futures. If you think the market is undervalued, don't buy the futures. There are other instruments that are more appropriate. Because what happens when you think something is being valued wrong with the market, if it goes further, it's an even better setup. So this leads to this kind of spiral where you take a bigger hit than you wanted to, and then you look at the situation and you're even more convinced that you were right originally. So you're much more likely to double down on the setup. And if that goes against you and knocks you out again, say you start with a $75,000 account, your initial hit takes you down to $68,000. But you're really sure about the position, and you see that the setup's even better now because it went further in the direction that you thought it shouldn't be going, right? Because it's kind of a reversion to the mean kind of setup. Well, you add to your position, it knocks you out again, and now you got $50,000 in your account. But it looks even better. The setup just keeps getting better every time it takes you out. And the futures market keeps giving you the leverage to try to make all of it back right away by increasing your size. So that kind of setup, right off the bat, there's nothing wrong with the value setup. There's nothing wrong with the reversion to the mean setup. But it's just not for futures. If you want to trade futures, use it when you have falsifiable setups. So a real quick example of a falsifiable setup is, let's say there's too much spec long interest in crude oil. I'm bearish on crude oil because I think too many people are leaning long with it. And the EIA data comes out, and it's really bullish data. And the market spikes up, and then it starts to go back down. That top, that initial news reaction spike, is an excellent falsifiability level. I can short that market, put a stop up there, and I know if it grinds back up through that high again after it's already rolled over, I'm wrong about that setup. I can be at peace with the idea that I took a loss and I moved on. So with that said, first off, I want to see if all of this, does this make sense to you so far, Andrew?
Yeah. So some of it makes sense. I think like one just general question I would have, especially when I was listening to you talk about like leverage in general, when you're especially talking about earlier going from like, let's say like $75,000 to like $50,000. Can you just kind of just like basically for someone like me who doesn't really know much at all about like how futures work in general, when someone says that, for example, and this is just all like these are all just like hypothetical examples, and you can correct me if my language is inappropriate or like whatnot for this hypothetical. If someone looks at the market today and they say, you know what, like I think, and this is again a hypothetical example, I think that the market here is extremely like, I know you said not to use like a value setup, but just for like purpose of an example, I think the market's like overvalued and I think it's going to go lower. I want to bet on the market going lower. So in that type of hypothetical example, let's say someone says that they want to short, like an example, someone wants to short the Dow, for example, from here, an example. How exactly would they go about doing that? Like what type of like contract would they even like look, what are the different types of contracts they might even like look to buy? What would like a contract, let's say like they did decide to short one of these contracts, shorting the Dow or a different index or whatnot, what would that actually mean? Like when would it expire? What would be the example of like, oh, maybe I took like a hypothetical like $10,000 short here and the market's just like shot up like another like 3%, like just immediately, like right after that position, would I be down like $5,000 from like $10,000 basis? Like general questions like that.
I gotcha. So first of all, if we start with the idea that you're structuring setups where you have a stop loss, first of all, just consider that to be a universal point here. Don't trade futures if you're not going to use a stop loss. Okay, so there needs to be a point where you're wrong, and it's not just a time. That's why value setups are tough, because it's got to be, if the market goes against you a certain amount, you've lost, let's say 2.5% of your capital on that trade. You're now wrong on that trade. Like you're done with it. You just move on. So you get this little window of risk to make a bet.
Hey, Brett,
and you have to start. Yeah, go ahead.
One thing I'd like to add on is one of the keys for trading futures is the liquidity and the fact that you could put those stops in and you could trust them too. So that's another thing that's really important to remember about the futures. Just that's one of the reasons why people like using them, because I know I do, because of the liquidity and because you could set those stops and have them triggered once it moves through it.
No, that's exactly right. So let me go back around to Andrew's kind of the bigger question in there, but that's exactly right. So you can have this methodology with futures because you have such a deep liquid market. So you know you're setting up a wall where if it goes past that, you're out. It'll take itself out. It's an order that you put in a native order chain on the market. You just forget about it. The order's there. If it gets to that price, it takes you out of the position. But to get back to the instruments, so in this case, if you were looking to short the Dow, there's a contract, the Dow E-mini futures, the symbol is YM, and in this case, it just expired. It expires every quarter. So it's actually running off now, but it rolled. So there's two terms. I don't want to get too much into terms because we're going to send out a handout with some of the terms, but just for the practical point of this answer, so there's a roll date, and that's really the one you need to be concerned with. You don't really worry about expirations. The roll date happens about 8 or 9 days before expirations. But the roll date is when all the volume goes from one contract to the next contract. So the roll date in this case was the 8th of March. Just last week, Thursday, I think. We went past the March expiring contract, and all the volume on all the equity futures went over to the June contract. So everybody was trading March expiring contracts, and now they're all trading June expiring contracts. But it's the same market. It's just, for practical circumstances, I don't think that most of the people listening to this, or you, probably need to worry too much about rolling contracts unless you're trading right around this. If you're thinking more on a swing-based or day trade-based method for futures. If you're thinking about longer-term positions, you probably don't want to be using futures in the first place. Does that make sense?
Yeah, no, that kind of makes sense. And I guess then kind of like another kind of more just like basic question that I might have is like how long, like when you're mentioning like the roll date expiration of like March 8th, like for example, how long, like if I would initially like enter into something, like how long do you have to like necessarily hold some of these contracts for? So even if I'd enter something in, I make a trade of some kind hypothetically, and the roll date would hit, and I don't want to get like too into this stuff like right now. If my roll date hits, like what happens to that trade? Does it just roll over to like the March 9th like area?
No, the roll date just means that the volume, the intraday volume, the liquidity starts to move on to the next contract. It's like a group. Okay. It's like a group agreement. We, as all the people participating in this market, hereby agree that we'll, on this date, start to trade the next contract. And so the existing contract just starts to peter out in volume until it gets to expirations, at which time it's generally arbitraged back to the spot index. So the Dow futures will end up at the spot future, or at the spot Dow price. All futures markets expire at the spot price.
And there's another thing, Andrew, with that expiration. I mean, technically, if you have long in, say, the gold futures, you would get delivery of gold.
Really?
In theory, once that contract expires. Now, not too many brokerage houses do it, but I got a perfect real-world example with Interactive Brokers, where I do a lot of my futures trading. When I had silver futures and they were about to expire, and I'd gotten an email, I wasn't paying attention to it, but I had gotten an email in it where they will automatically roll you out of that contract. And they'll do so at a lower price. So it's something that you want to, and I remember just looking at my account and being like, hey, why am I out a couple $100 there? It's because I was automatically pushed out of that contract expiration. Now, one of the things that we will be doing is providing some companion materials, and you could actually track and look at when future rollover dates are going to be to give you a better idea. But that's something that you always want to kind of be careful of. As you saw today with the short I took in the E-minis, I moved it over to that June contract, the M's. And it's just something that you always want to have in the back of your mind when whatever asset class you're trading, does it expire on a monthly basis or a quarterly basis? And just always be tracking that, because you can lose money if you're not paying attention to that. So,
does all that make sense?
Yeah, no, that does all make sense. And I guess just kind of like a general, more bigger picture question, especially as we kind of pivot back to you guys talking about people like blowing up, maybe something that people wouldn't know. So my first in the general question is, why, so risk reward perspective, if someone's looking to enter into futures, obviously when I see different futures trades just on the internet and whatnot, when people are talking about these points that they're making from these trades, to me, if you buy a share of stock at $100 per share and it goes up 8 points, it's and you sell it at when it's going up 8 points, it's pretty simple to be okay, 8% times whatever your cost basis is, minus the fees. In futures, when you have moves on any of these different indexes, what is the type of reward? When you say you short something and it makes 50 points, for example.
No, I got you.
What does
Let
that
me go
mean?
ahead. I know exactly where you're headed, so I don't mean to cut you off, but I do know really where you're going, and I think I could probably phrase the question for you better than you're going to right now, which is there's a big conceptual shift that has to happen in your mind when you think about futures markets versus when you think about stocks. So futures markets, don't worry about the notional value of the position, which is in theory, if you might buy a futures position and you look at your account and it says that the position's $800,000 in size, and you just put a few contracts on, and you don't really understand what that means, but you don't even need to worry about it. You don't need to think about it. Futures contracts, you have to think about the margin, and every broker varies. So you can buy, if you have a $50,000 account and you're using, most brokers will want $5,000 or $6,000 per contract as an ante up for the S&P futures. So you could maybe get to 8 contracts on the S&P. Some brokers allow more leverage. There's one out there with $500 a contract, which I would just recommend not using, because that just fuels the ability to blow yourself up. It's like a super fast chainsaw with no safety. But the points work like this. So in the S&P, it's $50 a point. If it goes 10 points against you on one contract, you lose $500. If it goes 10 points in your favor on one contract, you make $500. It's just $50 a point. It's the way the contract is geared. That's it. You don't need to know why. That's just how it is. So the NASDAQ 100 futures is $20 a point. So if I risk 15 points on that per contract, I'm risking, I know the amount right away, and it's not based on the size of the position that I have in terms of notional value. I don't own that much of the S&P. I would get that much of the S&P given to me on expirations if I hold through expirations as a cash position in the 500 stocks that are in the S&P 500. Right? But that's not what I'm interested in. I'm interested in using the leverage to be able to take a certain amount of money and give me geared exposure to where the index is going to go, because I'm making speculative bets on where the index is going to go. And with the futures, there's a certain number of dollars per point, and that's just how the futures market is priced. It's always been that way. Does that make sense? Did I lose you?
Sorry, my apologies, Brad. I didn't have the button on. But just to recap for a second, what you basically just said. So for an S&P futures contract, every single tick up or tick down is basically $50 approximately per contract that you're holding.
Yes.
Okay, and for a NASDAQ, every tick up or down is $20 approximately, or $20 per contract.
Correct.
Andrew, here's one easy way of thinking about the E-minis. It's basically, $50 for each point. So what you really do for the valuation of the S&P, it's 50 times whatever the S&P's trading at. So when it was at 2,800, it was $140,000 for one contract. However, on margin, you were basically paying $25,000 for it, if that makes sense. And this should be laid out in like your brokerage firm, and you should always be able to have a clear value of exactly what you're buying on margin and everything when you're buying that with whatever brokerage firm you're going through.
Okay, yeah, but I'm going to follow that with the point that if you want to think strategically about setups, about managing risk and managing strategy, I think really thinking about that sort of underlying structure almost confuses things more. If you know a basic set of rules and you know them well enough that you can truly depend upon this sort of input-output function of interacting with that market, then you understand. So the second point I was going to go to on avoiding a blow-up actually plays right into this. And it's the mechanics of structuring your setup. Gavin had a nice S&P short earlier today. He put on 10 points of risk because that was the level at, and I don't want to put words in his mouth, but I'm assuming that was right around the highs of the morning where his stop was. And basically, if the market was going to move back to the highs, he was going to consider the setup falsified.
That's exactly right.
Yeah, and so, at that point, he knows, based on the fact that it seems to be shifting in momentum, he's got an idea that he wants to be fading this market somewhere in here. And as he starts to see it behave in a way like that, then he knows here's a falsifiable point. If I put a stop there, then I understand my risk. It's $500 a contract. So let's say you're talking about a person with $100,000 in their account at random who's in the same situation, and they have a rule, and it's a good rule, I think, to not risk more than, say, 2 to 3% of your account in any one setup. Then you can work backwards and understand how many contracts you should take in that trade based on where you're going to put your stop. So you first identify what you're risking, and I think you should look at every future setup this way. You have a falsifiable setup, and you understand where your stop is going to be, and based on this, sometimes you need to risk more than 10 points. Sometimes you have a great idea, and it's 25 points of risk. It just means you're taking 40% of the size. You determine your size based on where your level is that you're using as a stop. Does that make sense? Because it's probably the most important point.
Yeah,
structuring the setup.
I think that does sort of make sense. So then kind of like just using just an example, because I'm like a practical person. I like to it makes sense, but I like to actually applying what I'm actually hearing. So when someone says that or they're risking 10 points on an S&P trade or something like that, when they're risking 10 points, that means 10 points, so S&P would be $50 per point, correct?
Yes.
So $50 per point times about they're risking 10 points or whatnot. So they're risking, I don't know if I'm thinking this through. So they're risking $500 per or how would that for the contract? Okay.
So let's say you are in a situation financially where it's no big deal for you to lose $3,000 on a trade if you like the trade.
Sure.
Okay, because you can make 10,000 if you're right. Right? So that's the other thing, the other side of it. Once you know you've got this point where you've got an anchor to your risk, then you think about what you can make, but only after that. So if you're risking 10 points and you're somebody who can risk $3,000 on that trade because that doesn't really put much of a dent in your account, that keeps you at a 2 to 3% loss or whatever, a good place to be, then you can take six contracts in that trade, right? Mm-hmm. Because 6 contracts times 10 points times $50 a point is $3,000.
Yep.
So that's how you get to your size. That's how you know it's 6 contracts. It's not more than 6 contracts. Just because the broker will let you trade 40 contracts doesn't mean you should. Because if it goes wrong, you're going to seriously damage your capital.
Yeah.
And that's the whole point here, is you also shouldn't use that chainsaw with no safety equipment, no safety on and a six-pack of beer in your hand, right? Because you're going to end up in the ER at some point. Maybe not today, maybe not tomorrow, but if that's your habit of action, at some point you're going to blow yourself up.
I mean, it's really no different from equities, Andrew, where if you had to stop in, say you're having, there's a $10 stock and you invested $1,000 in it just for argument's sake, and you had $100 that you could lose, you'd have your stop down at 9. It's the same setup for futures. You're just using the points instead of like the dollar share price in terms of where your risk tolerance is. So,
Yeah.
I mean, you should always have that situated first before you take a trade. Never put on a trade and then figure out where you're going to want to have your stop. You want to have your stop in. You want to know what your stop's going to be ahead of time and have that ready to go right away, as opposed to, sometimes with an equities trade, you might let it go a little bit more. But it's no different with the risk reward. You're eyeing up areas where you want to get to, and you're also putting in what your risk tolerance is when you have your stops in.
I gotcha. No, that definitely like makes sense. I guess like another this is general kind of like a bigger picture question I have is how often can people engage in like futures trading?
Okay, so there's no pattern day trader rule with futures.
Okay.
So if you have less than $25,000, it doesn't matter. You can trade as much as you want in and out all the time. So the answer to that is really as much as your broker will let you, as long as you still have money. But again, that doesn't mean that's what you should do.
No.
Right? So you can. There's nobody who's going to stop you. So futures are kind of like, giving you sort of the adult pass to something, whereas everything else is kind of treating you a little bit like a child. Like you can't take that much size. You can't trade more than this many times. But with that becomes, it's on you. And sometimes people are in a situation where if they're emotional with their trading, they don't have the self-discipline to stay systematic, and that's why you hear about blow-ups in futures, because you can trade more leverage and you can trade as much as you want.
Yeah, I mean, especially like I was just in my head like doing some different like basic math there, thinking about like blowing up in like hypothetical situations. So like if I buy like this is again just like all hypothetical. I just like using actual examples to try to like understand. Sure. I think it really helps me at least learn more. So then for an example, like if I buy like, and this is just again like hypothetical example, if I buy like 8 S&P like future contracts, like assuming that the S&P is going to go up, for example, like a mini contract or whatever, S&P drops like. And this is again like hypothetical. S&P drops like 100 points or something. That's again like hypothetical. Like, hopefully that wouldn't happen, but you never know. It drops like 100 points or whatnot. Does that mean that I would that I would be on the line for if I got stopped out at that point in time? It'd be like 8 times 100 times $50 approximately.
Yeah.
So that would be $40,000 like very quick like blow up. Okay.
And so here's the thing, right? I think that with even a conservative broker, you could get 8 contracts if you have $50,000 in your account. So there are brokers out there that would let you do that with a less than $40,000 account. And here's why they don't usually, because that happens to people. And the broker has to automatically expunge your position. They have to clear your position. And if they end up with a negative account balance, the broker is responsible for the difference. Your accounts, they could try to get it from you, but if it happens to a lot of people, like there's a crazy move that happens in the market, a flash crash or something, they're going to structure this leverage so they don't end up with a bunch of people who aren't going to pay them back for negative account balances, and they end up with a big bill. Mm-hmm. So that is possible. So this is another reason why to use stops, right? So if you have the stop order in, it's a liquid market. Very rarely in something like the S&P where your stops not trigger at just about exactly the point you put them. Even when there's a crazy type of market like we saw in early February. There was more slippage then, but not a crazy amount. It's still a really liquid market. And you have that advantage. And obviously in a market like that, you trade smaller and smaller. But the stop being a native order on the exchange that you never even consider canceling or moving is a good practice. You'll never have that 100-point move against you. You'll be stopped out at your level, and so just always have your own barriers. Does that make sense?
Yes, that makes sense.
Okay. And now to confuse things even further, there's points, and that's not really the universal kind of amount in futures markets. There's something smaller called a tick. And a tick, for instance, is the smallest amount of movement that can happen in the S&P. It's a quarter point, right? So you can move quarter points in the S&P futures. And each one of those quarter points is $12.50. whereas it's $5 in the NASDAQ and it can move 20 bucks for a full point. So ticks are pretty universal across things, where most ticks are around. So even like in the currency futures, most ticks are somewhere either between 650 or 1250. In crude oil, it's $10. So all ticks are usually kind of around this 6 to 15 kind of area. Silver is bigger. Silver's $25.
Gold's 10.
Gold's 10, right in that middle kind of point. So there's sort of like a translation across everything. And one thing that I've recommended in the past with people who get into futures markets is to actually learn the tick standard rather than the point standard, just because you can kind of communicate it across every asset, and you think in terms of the number of ticks I have to risk. That's why I often post my trades in terms of ticks on the risk. With the S&P lately, because the ranges were wider, I've gone back to points, but it's at least understand there's almost a universality across different markets if you think in terms of the smallest unit of possible movement, which is the tick. And then for whatever market you're looking at, understand how big that tick is in the market and how much it will cost you. And you can kind of get pretty universal about how you can quickly gauge setups across different instruments in terms of risk. Does that make sense?
Yes, it does. Yes, it does.
All right. Good. I think we are hopefully. So is there... I think we got to go back to you, Andrew, and just tell us what it is you want to know.
Yeah. So I definitely my biggest thing going into this is I really wanted to, at least for this initial kind of session that we're having, is just kind of understand the risks. And I think a lot of what you kind of walk through as far as ticks and points go, really helped me at least understand a picture for the different risks that are out there. And of course, whenever anyone's going through any type of decision and whatnot, they should always understand the risks associated with whatnot. So that was phenomenal, and I really enjoyed that. I guess another little question for you guys, and we kind of brought this up a little bit earlier, was just any type of I don't want to go through this horror. It can be a horror story or a success story that you might have witnessed in your time, where someone maybe just didn't quite understand what they were doing, whether it was you or somebody else that you guys might have been encountered with over the years.
I've certainly got one if you want to go, Gavin. But I can.
No. You fire off first.
Well, it was a few years ago. I got caught in one that was pretty bad. In 2011, in April, in silver, where I got hit hard because it was a great reinforcing lesson. Because silver was at $50 an ounce at that point. It was its most historic run ever, and it was trading kind of really crazy. And I've been trading silver a lot around that area on both sides, and it had been really, really, really good for me. But on Sunday evening, the futures open on Sunday evening at about 6 p.m., and there was a sudden move in silver. It just caught my eye. I think I was like making hot dogs or something, and I just caught my eye. And wow, this is crazy, this move. It suddenly dropped 4% in 2 minutes. And worst decision ever. Wasn't really even thinking about anything. I just bought a couple contracts of it, and I just can't even account for that decision now. But it turns out that a bunch of brokers just came out and raised margin requirements on silver because it had gotten so volatile. And this is often the thing in a really strong trend when a market gets really volatile. Brokers will raise margins because they don't want that thing that you just described, that 8 contracts for 100 points can wipe out accounts and leave them with a big bill. So if the S&P started moving 150 points a day, you can bet they would come out and raise margin requirements a lot, meaning that at a certain amount of capital, you can afford fewer contracts. So it reduces how much size everybody's trading. And with silver, they did this, and it just took the bottom out from underneath the market. And it was down 3 or 4% when I bought. And silver on a Sunday, so everything I said about using stops, you also need to understand that there are certain peculiar instances where stops are less likely to trigger. And if you're trading Sunday futures action in silver, which is already a relatively thin market, my stops did not trigger. And it went down 12% in the next minute. And it was just an enormous hit. It came sprinting back a little bit after that, but it took a big bite out of me. And it was just 100% my fault. Trading silver on a Sunday, even at small size, at that point that was very small size for me to be in that market, still, it was enough because it dropped so far, so fast with no bids whatsoever. And it showed that was a market that was essentially prone to crash, and that was the top. And if you look at silver, it lost 80% over the next couple of years. That was when that sort of mania run ended right there. And that crash, it was a good lesson. It's a Sunday market. It's silver. It's the most volatile, probably futures market that there is. And it can be really thin, and especially on a Sunday. And it was at one of these sort of extreme scenarios. So it's kind of a rule of thumb there to stay away from situations where, you really don't have that type of protection. So it's always think about being able to protect yourself in any crazy scenario. And if you've got a really liquid market, particularly during normal market hours, you really don't have to worry about this. But, there are certain scenarios where you can give yourself a lot of extra risk.
Gotcha. How about you, Mr. McGuire?
Yeah, but mine was probably more around just buying the wrong asset. There was one time, now I didn't really get crushed on this, but this is kind of the one lesson that I'd like to point out, is make sure you're buying the proper contract that you're looking to do. And that is always sticking on the indices side with the minis, not a full contract. So my war story basically is I went in to buy the Dow minis and I ended up buying the full contracts and therefore had way more leverage than what I was looking to have on the board here. And it's when I first started trading futures, so I was just looking at it, I was just freaking out. I remember,
how did you find out, if you don't want me interrupting you, that you made a mistake?
I just looked down at the amount that I had in my portfolio, and I was just like, oh no. And then I just went back and I realized that I clicked on the wrong contracts and it brought the full contracts and not the minis. I mean, the minis were only created in 1997 and they were created specifically for smaller traders like me. Contracts were just simply getting too large for it. So I'm not sure exactly what the percentages of it is for the Dow minis compared to the full contracts, but let's just say that a couple of moves here or there and I could have definitely taken a severe beating and literally blown up my account. So luckily it was on a very low volume day and there was really no move in the markets, and I was able to eventually sell out with little damage to my portfolio. But it was a lesson learned. I always double check and triple check to make sure that the symbol that I'm buying and the contract that I'm buying is indeed the correct one, because if you're not paying attention, especially with a lot of these currency futures, they have a couple of different contracts out there for things that you could easily get involved in, and you could be buying a less liquid product. I mean, I generally like keeping with the E-minis and the NASDAQs just because of the liquidity in there, but some of the grains or some of the currencies simply don't have that liquidity. So, you don't always want to use futures if you're trying to achieve an objective in a certain asset class. But, for me, it's always just double checking and making sure that you're buying the proper instrument. And kind of like what Brett said, I never, there's times when, a perfect example would be when that Tillerson headline popped out. I'm like, oh, I got to get short. And for me, that just never, the reaction to a headline or the reaction to a certain news story never seems to really work out. I seem to do better with allowing things to play out. That's kind of why the short that I got into, I'd let everything play out a little bit with the Tillerson headline, and then I entered in. And for me, I'm better at working that way than just moving to snap judgments on things. And you're, like kind of Brett said with his trade, you might be a little bit more prone to perhaps buying the wrong instrument or just not really thinking through the trade. And so I never like to make snap judgments on any futures trade. Equities I'll feel a little bit more comfortable with, but futures, just given the leverage you have there, I always like to be very careful when I'm entering my trade, and to kind of just make sure I've thought it through, both the risk and reward, and have everything set up before I jump in.
Very, very, very cool. Very, very cool. And one of the reasons I just kind of asked that question is because when I first started learning about investing, I got to watch one of my friends, this was in college way a long time ago, lose a tremendous amount of money because he didn't really understand some of the risk behind what he was doing. So I always kind of like to ask that question, so at least people do understand that there is obviously there's tons of reward, but there is real risk as well.
Yeah, good, right. And so exactly right. So I just want to kind of summarize where we're at. I think that we've kind of covered pretty much what we wanted to cover in this first episode, just a general kind of roundtable back and forth, being able to field questions from Andrew. But I just wanted to cover again kind of some of the main points that I think are most important to take away from this. You can use the futures markets like a power tool version of other markets, but you need to have certain points in place that you absolutely chain yourself to systematically, or you're going to end up with one of these types of bad experiences that can really be psychologically painful and can lead to a feedback loop where you then get even more impulsive and have more of a gambler's instinct. Because again, the cause of a blow up in this kind of thing is not because of some mechanical problem with that market. It's because of a mechanical problem with human nature. And it just gives you the tools to do that to yourself. And so there are ways to avoid it 100%. And that is, first of all, use futures for setups that are falsifiable. There's a level where you know if it moves past that, it's not the same thing. You don't want any part of it. Those are the opportunities to use futures. You put a stop there. And then you work backward from there so that you're mechanically making sure that no one trade like that can really take more than a couple % of your capital. And it won't lead to the feedback loop where you just keep putting the same position on again and again, where you find you're taking a small amount of risk and you're getting stopped out, but then you put the same trade back on over and over again because it's a falsifiable setup. So as long as it's a falsifiable setup, and as long as you use this mechanical setup structure where you know your risk is limited, you basically take the bluff off the table. And then you can just work on finding strategies that fit within that kind of system to be able to use the leverage of futures, because some of these trades we're talking about here, you could risk, $1,500 and make $10,000 in a few hours if you use this type of tool correctly. So I think that's how I would summarize things so far.
Yeah, another thing that I like to use it for a lot is just using it for a hedge. If when I think the markets are going to roll over, and I don't want to unload all my positions, what I'll do a lot is just put these trades on in order to to offset some of the losses. So that's another thing that you could use these futures trades for, rather than trying to guess the top in your portfolio. Just kind of help try to offset some losses potentially by using these instruments.
And then you've just got to understand the sizing and how it impacts your portfolio. Because if you don't understand that, you may take much more than your portfolio's exposure in futures and have an unchanged position. So what Gavin said, but make sure you understand the size implications of that.
Yes. So, well, I think that's going to do it for our first class here. This was just going to be an introductory. We're certainly open to any feedbacks that people might have in order to improve the quality of the class, or to also try to set us up with specific items that you're looking to hear about and that you're looking to get educated on within the futures market. We're going to be covering a lot more items in detail. This was just kind of, like we said, just a more 30,000 look view of the futures market and some of the basics in order to get people set up and to get some basic understandings of how it works. But we'll get a lot more into the nuts and bolts going forward. Again, we have recorded this session, so we will be putting it on our Briefing TV YouTube page for anybody that would like to review it. And we will also be providing some companion materials. And moving forward, we're hoping to have a little bit more charts involved in order to allow people to kind of follow along some of the discussions we're going to have. So, Andrew, Brett, do you have anything left to add here?
Which one of you is going to be to blame when I become a degenerate in the near future?
Well, that would be yourself, Andrew.
I was just kidding.
It starts with you.
No, thanks a lot, guys. That was a lot of fun.
No problem at all, Andrew. And we'd like to thank everybody for joining us, and we hope that you found some interest in this and some benefit, and we're going to continue this series moving forward. But again, write in with any questions that you may have or anything that you'd like to see added onto this show. Thank you guys very much. Brett, Andrew, thanks for joining me, and I'll talk to you guys soon.
Sounds great. Thanks, Jeff.